Michael, explain to us the 5-year rule when it comes to IRA conversions and contributions.
So we actually often see confusion with clients around the 5-year rules for Roths because there are actually 2 different 5-year rules that partially overlap with each other. The first 5-year is to determine whether the gains in a Roth account are tax-free, so whether they are qualified Roth distributions. The second 5-year rule is to determine whether the principal of a Roth conversion is penalty-free. And while they overlap, they really are separate rules. A 5-year rule for tax-free gains of growth and a 5-year rule for penalty-free principal from a conversion.
What are some of the planning opportunities? Because these are 2 different rules.
So the 5-year rule for Roth gains to be tax-free simply requires that some Roth account for you must have existed for at least 5 years. It doesn't even matter what the dollar amount is. Once the first dollar is in, the clock is ticking, and you can add as much money later as you want. Because of that, we actually find one of the easiest, most straightforward planning opportunities for clients is if they don't have some kind of Roth IRA, if they've never had one, create one with any dollar amount. Contribute even $100 or $1,000 into it. And if they can't because their income is too high, find any IRA or other retirement account and do a partial Roth conversion for just $1,000 just to create the account and start the clock. And you might not decide until years or decades later that you want to do a big Roth conversion or move other money into the Roth. But if you've started the clock for the 5-year rule for growth to be tax-free, once you satisfy the clock once as a taxpayer for your Roth IRA, you've satisfied it once and done forever.